Good morning, ladies and gentlemen. According to my calculations, the risk dial is getting better, not worse. We're somewhere around neutral, which is telling me that the situation is actually improving in the market, that all this period of bearishness has achieved certain results, and that we have a distinct possibility of some sideways actions in bonds and in equities, which seem to be tied at the hip. We shall examine why that could be the most probable outcome here. So without further ado, let's have a look at what bonds are saying. This is a monthly chart of the 2s, 10s, just to show you that basically we are as negative as we have ever been. If I change this to a daily chart, you will see that we are below the previous lows and that we are basically in negative territories, and the 2s are basically the only tenure which is moving. Everything else is pretty much constant. All the pressure is on the 2s, and that makes sense given what the various Fed governors and the data have been saying. Basically, they want to get the Fed funds rate up to the 3 to 3.5 terminal rate, and they want all the 10-years to basically trade above Fed funds. That means that the pressure is going to be on the shortest part of the curve, which is the 2s, while the 10s already anticipate a turn. 10s and 30s will be the ones which will move least. The 5s probably now move the most, and the 2s stay pretty constant, just above the 3% area. Whether it's 3, whether it's 3.25, whether it's 3.5, that is what the 2s are going to be trading on, but the 10s and 30s are probably going to be the most stable. And here we have the various other tenures, 5s, 30s, basically stuck. We need to break above 11, negative 11, to get more impulsion here. I don't think that is likely in the next couple of weeks. The other one which is interesting is the 5s, 10s, which is trading negative. This is 0, so it's trading at 11 points negative. This also is about as negative as it's been since, basically a long time. We can go back and we can put another line here, and that is basically -5, and we are through it. So we are worse than the levels that we saw in 2006 and 2007. Basically, the yield curve is fully priced in and we're going all the way to where is this? This is all the way back to the 2000 crisis, and if we put a line there and we take it back to where we are now, we will see that it's a little bit higher than this, but not much, right? So we are we are really at the worst levels that we have seen for many years. The trend should continue at some stage unless the data turns. Only a turn in the data will get us back down towards a flat yield curve. Given what all the Fed speakers have been saying, and there's an excellent speech by Weller, which I completely agree with. I understand what his point is. I understand what they want to do. It's very likely that the 5s are now stuck between this point at worst, 267, 268, and the highs that we saw here at 359. I very much doubt that we will come out of this range for quite some time, certainly not before we see the CPI data for next month. It's very unlikely that the Fed is going to do anything more than a 75 basis point in 2 weeks' time. And it's very unlikely that the market will price in anything more than another 50 when they reconvene, unless the data is very bad. It's unlikely that CPI is going to continue to accelerate, because we should now price in all the falls in oil that we've had over the past month or so. We'll look at that later, but that gives us a stability in bonds of a 50, in fives of a 50 basis point range sort of thing, and in tens. If we look at that there, I think it's very unlikely that we do anything better than 261, i.e. that we have another period of stability on the weeklies like this. In fact, it's very unlikely that we go below 273. It's not something that the Fed wants. The Fed wants all the 10-years to be positive. So down here, the risk reward is for another move up towards the 320s. I now see this 324 level as something which is unlikely to be busted on the upside for certainly a few weeks, but also this area around 273 to 261 is very good risk reward for another move up towards 3. If we look at the 30s, I would have thought 3%, what do you want to do, trades another period like this. 294, and I think it's more likely that they start going up again. Unless we get some amazing data, I think 294 is a very good risk reward for more, for higher rates. And especially if the Fed starts blinking. The reason why people are like the 30s up here is because they think, possibly correctly, that this is way above the terminal rate, and that sooner or later the economy starts rolling over. Quite possible, but if the Fed blinks, duration will be sold. People have been buying duration because the Fed is being aggressive. If the Fed is not aggressive, or it blinks, or it says enough for the time being at a level which is too low, then the 30s will get sold and you will get a steeper yield curve. That is not on the, those odds are not high at the moment, but certainly anything below 294, I'm looking for higher rates. Something like here, something like this period here. In Europe this week, we have the ECB meeting, and we already know what's going to happen. It's going to be a 25 basis point hike. But what will be more interesting is whether they start announcing something like a 50 to come after the summer, or hinting at it. The 2-year basically has come back a long way, exactly to where the support is, and that is why I think the likelihood is that we start going back up towards this 70 to 75 area. Let's call it 70. I think it's very unlikely that we break down and stay down. So the fact that I have puts on the shats is indicative that I'm afraid that we might do that, but that I am really not afraid that we come back. The reason why the shats is bid or not as offered as I thought it might be, the reason why we're not at 70, the reason why we're 43 and not at 70, is that there is a huge collateral shortage in the market at the moment. But that is a technical thing, and that happens at times. And then the ECB puts things right by whichever means. I don't know what they're going to do, but they are certainly thinking of something. People are hoarding the short end of the German curve for regulatory purposes. That at some point changes and the market readjusts. So given the fact that my options have got nearly another 2 months to run, I am not afraid of that. I think any move through down towards these levels, and what is that, 9-10 basis points, is going to be another great opportunity to add to the position, because there's no way that the inflation in Europe is lower than the inflation in the US. And basically this is just a, how shall we put it? It's a bit of an anticipatory panic of what the economy might do. I don't think that makes any difference. Inflation is inflation, and bond yields respond to inflation. Sooner or later, we're going to go and retest this 107 level. Over onto the bubble. And the strange thing in the European yield curve is that it's relatively steep compared to the yield curve in the US, which is negative, flat to negative. And I think the terminal result will be that the European yield curve will resemble the US yield curve at some stage, and that's why I prefer to play the shorter end, the 2s and the 5s, rather than the longer end, the 10s and the 30s. I think those have repriced. What hasn't repriced is the 2s and the 5s. We are in no man's land. I would have thought that this is going to be excellent support here around the 64 area. If we break down, I do not exclude coming down towards this kind of area, a little bit. But I know that the path of least resistance at some stage is for higher yields in the 2s and the 5s. Therefore, if the bubble next week comes down to this 47, 45 area, I will initiate another position in put spreads in the futures, looking for eventually to come up towards the 120. Changing over to the 10s, to the bunds, you can see how basically we are stuck at this level around 117, 113, 117. That is basically it. I still think that this should be the least volatile. This should basically move sideways, and it's the 2s and the 5s that should catch up. If we look at the French market, it's come back to support. Could it come down, here towards 147 and fill these gaps, 145? Yes, but I don't think it moves very much through there. I would be very, very surprised if we end up next week through this level of 144. I just don't know what the ECB needs to say or do for that to happen. To me, the more hawkish the ECB is, the more people want to buy the 10s rather than sell the 10s. And the danger is that the ECB is not hawkish enough, and then the market comes down towards these levels and then spikes back up towards the 2% area. The differential between the US and Germany keeps them basically on average being stuck around this 181, 182 level. I still think that the way this market will resolve itself, and this is a weekly chart, if we put it onto a daily chart and go back slightly, I think the way it will resolve itself is through a breakdown towards 1. Why do I think that? It's because the ECB is so far behind the curve, and the Fed is now so aggressive that at some stage people have to start thinking that inflation in Europe is going to be continually worse than inflation in the US, and that we just don't merit having almost 2% greater yield in the US. I just hate European yields being that high compared that low compared to US yields. I think over time the differential has to come down because the inflation differential will also come down. And to me, it just makes no sense being long of European bonds when you get so much more value out of US bonds. Well, the dollar continues its merry path. It is so hugely overbought and so far away from any moving average on the dailies or the weeklies that basically it's becoming a bit of a joke. I showed you this, the previous level, which we were back here around the 111 area back in 2000 and all the way to 2002. Would I bet against it? No, but all I know is that the dollar is taking out all the oxygen in the room, and it's basically making emerging markets so damn, so damn cheap that at some stage when the dollar reverses, emerging markets are going to do well. I just don't know what to say about the dollar unless it closes below 106.25. You don't have any kind of a reversal, and certainly if it comes down to 102.82, the world and his mother is going to want to buy it because it will have normalized itself and will be ready for another move higher. But on the dailies, we just know that it's very, very overbought and a long, long way away from the moving averages. With the ECB, it's more likely that we come and test down towards the 106 area. But would I bet on it? No. I think that once it gets to 106.25, it's more likely than not to try more stabs higher. But all I know is that until we get a distinct reversal pattern in the dollar, we are unlikely to get any kind of sustainable strength in the equity markets. Risk is just not going to be bought aggressively until we have at least stability in the US dollar. I think Euro USD is fairly clear, clearer than the Dixie. You can see how oversold it is, but it makes no difference. A trend is a trend, and you really don't want to fight it. You just want to see where the good risk-reward levels are, and that is still 103.40 on the weeklies. You really need to have a close above there to have any reason to believe that the trend is over. On the dailies, you can see where the moving averages come in, and that every time it's touched this moving average, it's basically collapsed from it. So this kind of area, just above 104, 104.60, becomes very, very good risk reward for a turn back down. It's unlikely to me that we have seen the absolute top in the US dollar, but any kind of consolidation and move, 3-4% better is going to provide a window for all risk assets to rally a bit. Now, why would that happen? Well, it can only happen really because the ECB gives you some sort of a hint that they might accelerate their their tightening. Is that likely? I don't know, which I'll find out on Thursday when the ECB comes out. But they really would need to accelerate tightening because it's really ludicrous to have the Fed, as Bullard has said, being at the neutral rate of at the terminal rate of 3.25 to 3.5, or as Weller has said, to be already at neutral with this rate hike that they're going to do of 75 basis points, and everyone's insisting on 75 as opposed to 100, and to have then the ECB so far behind neutral still. They need to accelerate, or at least to give the market some hint that they're going to accelerate. If they do that, we can have some correction in Euro USD back up to these levels. If they don't, the trend should continue. Gold, just like the US dollar, is at a very interesting technical junction. You can see these weekly lows here. The only problem is that if you look at the daily chart, we have this support right here, and that is where we are. But to me, it's so unlikely that we have a quadruple bottom that to me it's much more likely that we spike down. And if we spike down, what is the level that you're looking for? Well, the only level that you can be looking for is for some kind of something like this. Okay, that's the only thing that makes sense. And the 100 comes in at 1580. There should be a lot of pressure on gold below these levels here around 1690. And you can see the way it traded back in early 2020. So I really wouldn't exclude a move down as far as this. That's all I can say technically. I think it's actually unlikely to go all that way, but then copper was very unlikely to do what it did, and it did it. Here we have copper, and really was a textbook move of liquidation, and when this whole area here of longs got busted, it just fell apart. To me, copper is now becoming an excellent long-term buy for a long-term book. These levels around 290, 280 become wonderful risk reward for someone who is willing to hold them for a year or 2 years. And if we look at what copper gold is actually saying, and this is what has arrested the move down in bonds, down in futures and up in yield, can it come back down? Absolutely. I don't think that is even unlikely. So could we have a couple of weeks of copper slightly recovering and gold not doing very much or spiking down? Absolutely. I don't think that is unlikely. Given where we are in the relative position between gold and copper, that is very much a possibility. And if anybody has a very long-term book, putting some copper away at these levels and averaging as it moves down, I think is a very, very good idea. DBC, to me, this 24.39 level is crucial. If we manage to to break down below it and close the week below it, I think then the bonds are likely to do better. I Or let me put it another way, that all pressure to the upside will be taken away from the bonds, because quite simply, if the oil now starts coming down, it's quite certain that the CPIs in the next couple of months are going to be better, and that is going to remove any pressure for the Fed to do anything more than the penciled in 50 basis points, and then the market can even start looking for the turn. I don't think the market can start looking for the turn in US yields until we get this this under control. We broke that level in we broke above this 2285 here in April. We are back, and if we go now to a 30-year, where was it in April? We were here, we were 280, and then we spiked up following it. I think we're quite, if DBC now starts breaking down, I will be looking for 270 as opposed to 294. Well, wouldn't it be a wonderful irony if just as earnings are turning, the market actually did a little bit better? I think the market is probably, unless these earnings, and next week we get some really big earnings, and over the course of the next 2 weeks we will have most of them out, most of the big boys. I think the market has discounted probably 90% of what is likely to happen. Can there be a bad surprise? Of course there can be. But the likelihood of it is becoming less and less. I think that these forward earnings are going to turn down, but we are not at a ridiculous level in terms of earnings. Can there be a final leg down? Of course there can be. But I think over the course of the next 2 or 3 weeks, unless you get some very bad surprise in earnings, we are going to test the upside. Makes more sense than testing the downside. And this is why the fact that we can't break this 37.25 on the downside, where it's been support so many times, you can see here, 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 and here, tells me that we are more likely to break the upside here, which is 39.10, and go and test these levels here where the gap is just around 4,000 or 39.80. Let's call it 39.80. I don't think the market can run away, because I don't think bond yields are going to collapse, and therefore as a result the upside is whatever it is, 39.80ish, 39.74 is this level here, which seems to be a very nice swing level. But I think people will be surprised by the fact that a market which doesn't go down tends to go up and correct. So that is, to me, I just can't get bearish of risk assets at these levels at least until I've seen earnings. But for the time being, I'd see absolutely nothing which tells me that a collapse is imminent. If I have a look at my clean chart, we've touched the level that I thought was most important, which is 36.46, and this chart has been here for years. I mean, these levels have been here for years. Literally, I have not changed a thing. And if we enlarge this, you can see how, to me, this 39.83 level is almost bound to trade, because that 40.47 is the 100% of this. Well, we can actually change this to here, and what does that give us? About 40.30, which is just the fill of this gap. So over a few days going up to 40.30, well, why the hell not? I just can't see, unless we break this 37.25 area on my clean chart, I see absolutely no reason not to play it from the long side for a few days. NDX also is giving me some positive signals. It just couldn't break below this 11,500 level, 560 level that I said was support last week. Now it's much more likely to trade 12,440. That would be my minimum objective, and possibly 12,780. But somewhere in that area, I think we will stall out. And the thing that I keep on saying is that relatively we have moved out of the weakness of the leadership of tech, and I'll show you those charts now. Here we have NDX over INX, and it just refuses to move below this 303 level, where the 200-week moving average is. You know, I think it goes up towards 320, so does another 2-3% better, and then comes down again. But it's really, if you look at XLK SPY, it's basically in the same range as it's been for 2 years. And there seems to be very little pressure there at the moment. So I think what does that say to me? That says to me that other charts, like the bonds, are stable. There is stability in the bond market. Unless the bond market makes a move abruptly higher, this is unlikely to break down. And that tells me that there is unlikely to be pressure in the bonds for the time being. Otherwise, those charts would be anticipating it. So I really can't see. You know, if you look at this chart here, which is the QQQ over IWM, it's very, very neutral, and there are so many other charts like XLY over XLK that tell the same story. It's still in a longer term secular downtrend. You know, so XLK still being favored, you know, through over XLI for many, many years. And while these things don't move out of trend, I just can't see the NDX doing the leadership to the downside that would be necessary for SPY to have a nightmare. I just can't see very much downside in equities, in risk assets at the moment. None of my primary risk indicators like SPY IEF or SPY TLT, none of them closed in danger areas. They're still within where they've been trading for several weeks. To me, the danger is on the downside. But, you know, until that happens, I really can't see that it really matters. SPY TLT, much the same story. Even QQQ over TLT, very much in the same range that it's been since the beginning of 21. You know, I just cannot get too bearish of the of tech, and therefore if I can't get bearish of tech, I can't be bearish of the S&Ps in general and risk assets in the States in general. The fact that the VIX keeps on falling all the time, and now we're at the same levels where we were here is the 6th, 8th and 9th of June, and here we were trading above 4100 in the S&Ps. So it keeps on telling you that there is really no no impulsion to the downside, no panic whatsoever. We do have the 200-day moving average here, and that is it upward sloping, and these levels will be revisited. Basically, that's what it's saying. And on the weeklies, I wouldn't be surprised if we get down towards 21, but then bounce up to 30. So what it's saying is that, grosso modo, what it's saying is that the upside is not going to be that huge, and that there are going to be moves down from that upside. All the gaps have been filled. To me, that means, if we go back to an ES chart, is that we test up and then we come down. So good news is not going to be sustained, but squeezes are definitely possible over the course of the next few days, 2 weeks. And that is what makes sense to me. That's how I'm going to, that's how the interplay between the bonds, which are basically waiting for the Fed. When the Fed does 75, it provides stability. That stability leads to lower volatility, and lower volatility leads to squeezes. This 33.83 level seems to be quite magical in the stocks, and thinking about it logically, unless that 33.83 level gives way on a closing basis on the weeklies, and then we come down towards these levels, which are 32.60s, I can't see the US market being under pressure. I think this market is much more likely to have a relief rally when everything that they are discounting, i.e. that the Russians turn off all the gas and there's never any more energy in Europe, and etc., it's much more likely to trade 36.24 than break down. I will be a seller at 36.24 of the stuff that I'm long from here on the call side, but there you have it. So it's all really falling together that the next couple of weeks are more likely to be benign than absolute horror shows. I've updated all the levels. Not much has changed. The only part of the yield curve which is moving is the 2s10s, or whether you like to call it the 2s30s, which is the only one that makes sense that it should move. After the ECB, I really don't see any possibility other than that the curve in the EU, let's call it in the euro curve should start flattening. The only reason why it wouldn't flatten is because people sell bunds because they're not hawkish enough. To me, if they do that, they're stupid, because they are then endangering not only the euro, which is even more inflationary, but they're also endangering the stability inside of the euro itself, i.e. Italy and Spain. It makes much more sense for them to approach German rates towards where the Italian and the Spanish are than to try to do it the other way around, i.e. to keep German rates extraordinarily artificially low and try to push Italian rates down to German levels. That is going to be almost impossible for them, but we'll see what they do, and there should be some interesting stuff there, which I will naturally tweet to you. Gold, I still think it's for sale now. Below 1764, it's just for sale. I would avoid it for the time being or have much, much lower bids. I've left you the link to the Weller speech. I think it's something that you should read. It makes a lot of fundamental sense to me, and it really sets out the path for the next several quarters of Fed thinking. Naturally, it will be changed by data, but I think the likelihood that the data is going to be that much different from what they are thinking at the moment is not that high, and therefore it would really pay to understand what he's saying here. Thank you very much indeed, and I will tweet you tomorrow. Have a great weekend.